Welcome to Code and Concrete, the leading podcast for prop tech, conversations about the built environment, and other exciting innovations. If you learn something new, please consider following and leaving a positive review. Enjoy. Hi folks, joining me in the studio today, I have Dr. Chan An, and he is the founder and CEO of Tessera. A Wall Street veteran, Dr. An holds a PhD in Computational Finance from Imperial College London and has led initiatives in financial structuring, derivatives, and structured products at industry leaders including Goldman Sachs and JPMorgan Chase. As founder, Dr. An focuses on making private equity accessible to a broader audience. Chan, thank you so much for coming onto the show, and I believe you're tuning in from Singapore, so good morning, it's evening here. Great to have you.
Yeah, Matthew, it's great to be here. Thank you for inviting me.
Of course. I think we're going to have a very exciting conversation because the private markets and capital markets side of whether it's real estate or businesses is just as important as building them and the operational side. Everyone needs money in order to make that happen. We covered your intro a little bit, but why don't you take us back in time? How did you first get into computational finance and how did all of that transpire over time?
Computational finance, I suppose, the mathematics was something that always sort of interesting to me. And I felt I was better than, for example, literacy and, literature and so on. The especially using computational power to be able to do something in finance was very interesting early on. So that's what I focused on. And then after I finished my PhD in the computational finance, then I joined investment banks, mainly focusing on structuring and derivatives, as you mentioned, at companies like Goldman and JPMorgan. And I started my building on blockchain about 5 years ago, seeing a number of, if you like, inefficiencies that exists, despite the computing power, heavy computing power it uses, but building on the, if you like, older stack of technology that wasn't able to scale. And then seeing, especially when it comes to settlement elements, how powerful a blockchain can be, which everyone is now talking about tokenization. I felt that is one opportunity where you can really transform and build a better finance. So that's what I started. And in particular, over the last a year or two, I focused on giving private market access. Because having worked again for about 17 years, I've seen the machinery working in the investment banking that allows the value creation within the private market, but most of it is off limit to the largest investor pool, which is the retail. And for a good reason, to be honest. The technology wasn't there, the safeguards wasn't there. But again, I have a strong view that the introduction of blockchain and tokenization will be able to bridge the gap, essentially the access gap. And I think we're just starting to see that, in particular within the private equity space, which is what Tessera is focusing on. So it's very exciting.
For folks who aren't familiar with how private markets or investment banking operates, what are the major issues that lead to downstream effects like slow settlements, opacity, restricting retail access? What actually causes that? Because people don't really have an understanding of how these markets operate.
I think simply the biggest inefficiency is the settlement risk. The fact that you need to use multiple intermediaries to settle a trade, whatever that may be that you're exchanging. So now a lot of people think when you buy and sell stocks, that happens instantly, but that's not actually true. Behind there is a number of agents that are working together to settle your trade, typically on 2 or 3 days basis. So that gap of 2-3 days is then covered effectively by your broker, which is then held by the pool of money at the custodian and the regulator, and all those introduction of intermediary to settle the trades and involvement of a number of credit risks, counterparty risks as a result, make the whole process very, very inefficient. So with that, what then happened is, well, if I have to buy, sell some things through someone I do not know, I need to get the protection, right? Because, and also, especially because when I'm giving something to get something back, I may need to give something first before I get something back. So it's not just the due diligence you need to have on the product that you're buying itself, and the same applies to the counterparty, but also the broker that you're working with, associated parties that will be helping clearing that transaction. You have to do due diligence. Now, in the public market, a lot of it is standardized. Therefore, you don't feel like it. And that's where what regulators are focusing on the investor protection applies. And that's why retail investors have access. Where such investor protection doesn't exist, and you have the responsibility to do the due diligence yourself, is the private market. So private market essentially was created as a safeguard to that settlement risk, which is precisely what blockchains can mitigate with its atomic settlement. So I do not need to know you, because when we exchange anything of value, so long as we agree to a value, they will settle instantly and also atomically. So therefore, I don't need to take your counterparty risk, and you don't need to take mine either. And I think that's simple enough, but it is very profound change that the world, human history hasn't seen since we were born. So the mitigation of the credit risk is actually truly transforming.
Right, because traditionally you would have every party using their own books, acting as their own ledger, and then that constantly has to be reconciled. You introduce intermediaries who will look at both parties, their numbers, what's happening in the cap table, going through the corporate actions and ensuring everyone is at the same
Correct.
step, and then moving to settlement and finality. However, in a blockchain or on a blockchain, you have information symmetry. It's a distributed ledger, it's a shared ledger, and so we don't have to reconcile information between different parties. You can just execute. And it's mathematical in the sense that you don't have to doubt whether that number is accurate that's being displayed, or if that value is really there, or if there's a wallet on the other end. It's cryptographically sound in the present moments, and even historically, right? That's the immutable fashion. You can't retroactively modify that and say someone else transacted, or it was a different amount of value. So it's pretty transformative for markets. Getting into the retail portion, so you mentioned there's these investor protections that are created for private markets. Would you like to go over what that looks like, who's excluded, and why blockchains are changing the transparency portion, which could introduce new investors into the market?
I think as I mentioned, the biggest gap at the moment is if you think about I heard, not confirmed yet, but CME, for example, launched some time ago 24-hour trading, and then they decided not to pursue anymore, partly due to the overheads to the existing system and so on. Now, that may not be directly related, but that also speaks about the limitation of the existing infrastructure. Now, I don't recall on top of my head how many stocks, how many companies are listed in the public market, but the private market is far bigger than the public market, that's for sure. And the reason why we have a public market is, as I mentioned, because it standardizes everything, from your counterparty risk to the contracts that you're existing, and every company that are listed is subject to the same disclosure requirement, which is actually important, and that I want to go back to on your information symmetry, because you have to be sort of sensitive about what we mean by that, even on blockchain. Doing that for every single company isn't possible. And that's why private market exists. And that's why only certain companies that meet those strict criteria are available on public market. And that's also why those requirements are difficult for many private companies to fulfill. That doesn't mean values don't exist in a private company, right? So and that's why private market exists, where anyone who can take those risks, who can do the due diligence on those companies, who can deal with the lack of disclosures, can invest in those companies. Now, to people who may not be able to do, who may not have the capacity to do so, are therefore then excluded. And that's why you have the separation of private market and public market, and that's currently why the large part of the retail investors are excluded. Now, information disclosure is one thing, but if you think about what we go back to, the fact that you need to deal with the standardization of the products and the due diligence on the products, you also mentioned about the cap table, legal documents, and so on. Part of that big reason why we need to have that is because, again, it's a settlement risk, which is what the blockchain addresses. From that perspective, if you think about the two key reasons why private market exists and why it excludes the retail investors, it is number one, settlement risk, and number two, information disclosure. Now, the settlement risk is almost entirely alleviated with the introduction of blockchain. What doesn't, however, get mitigated is the information disclosure, and this is, I would call actually the information asymmetry, which does exist. But even there, the technology exists that helps with technologies like Oracle and so on, that allows the better availability of information that can be verified instantly and by multiple sources 24/7 on chain, and which can be far better mechanism to disseminate those information to everyone that needs to be in the know. So as both settlement mechanism as well as information dissemination mechanism, blockchain can actually be much more efficient than any other existing technology that we have, which is why I think we're seeing the blurring, if you like, of the public market and the private market.
I would agree with that. I think that now that the technology is present and we're able to process huge batches of data, we're able to disseminate the information on a shared ledger. There is a blurred line between what a private market asset is or should be and what a company needs to do in order to become public. It's becoming easier to meet the requirements or the scrutiny that public markets once had, but you don't have to finalize everything with the actual IPO. And we're seeing this in companies, especially AI companies that are leveraging their own technology, whether that's like Anthropic is a fantastic example of this, with nearly, I mean, they're working on going public now, but all of that value creation was actually prior to the IPO. And I think for a lot of investors, they felt like they missed out on this opportunity. And so this actually sets the stage for a really good argument, which is if so much value creation is happening in private markets before companies go public and are accessible to retail, and if we don't want that to become an issue or a socioeconomic gap where only the rich can invest in the best opportunities, bring this to retail. In your opinion, like what do you see as driving a lot of that value creation before companies even go public, and is there going to be an opportunity for retail to share in that value?
I think the fact that the private companies stay longer really driven by the two factors. One is there's this abundance of private capital, which means the companies like OpenAI and even Anduril and so on can raise hundreds of millions of dollars or even to billions without the disclosure of listing that we talked about. So there's very little pressure for them to go public. And the second factor is that the steepest part of the growth growth curve from a few billions to hundreds of billions happens now entirely in the private rounds. So as a result, public investors arrive after that re-rating, not during it. And I think that's the biggest problem. Now, so from that perspective, I think IPO as the broad access relationship has really fundamentally changed. It used to be a democratizing moment. The first time a regular investor could buy in. But I think more and more we see that that's inverted. A company that's has been private for 12, even 15 years, and has done the most of the compounding for private shareholder base. You as a public investor and retail investor buys into the company at a mature valuation. What I mean? But it's not a really sort of a moral failure of any company. It's just a fundamental structural shift in the capital formation. But I think what that says is that the consequence of that is really the widening access gap, unfortunately, intentionally or not. Depending on how you look at it, you can take a sort of cuts both way. I think what we are seeing and what we are doing at Tessera is trying to close that gap. Yeah, so I think that's what's happening right now.
It's a really good point, and I want to reiterate. So if people could imagine in their minds the growth curve that companies go through, it used to be that you would go public and there's this really big opportunity to let's say $5 a share to $500 a share. At this point, I'm not going to say it's impossible, but it's less probable because once companies have already reached a $500 billion or $1 trillion valuation, the odds of them going up substantially are less likely because there's just not that level of capital accessible. And so people want to get in earlier. So that's the point that we want to definitely double click on. And if people are wondering what's the biggest transformation now, it's that most of the value creation is happening out of reach of folks. Now, so in companies in general are looking at IPOs very differently. What really is the value driver if they don't need access to public retail capital at this point? If they know that it's not going to be a massive value driver for them, what is the incentive to go public?
I think that has also fundamentally changed. I mean, companies used to feel that are we ready for an IPO? And IPO has always been a very important milestone within that value creation. But I think more and more what we see is IPO timing itself isn't really the market readiness, but it's more of a what I call liquidity orchestration problem. You have to, as a founder, you need to balance employees who have been waited not a few years, but perhaps more than a decade for liquidity. You have early investors. You have to bear in mind a lot of VCs and P funds. They have 10 to 15 years in the fund life, and if they invest in, even if they may need to return the fund, right? And the late stage holders who came in at a higher valuation, don't want to stay, for a down round. So there are multiple players that you have to satisfy. So going public at the end becomes one such liquidity valve, if you like, among several available. So now those include secondaries. You've seen companies doing the tender offers, even the structured products and so on. So it's less about the debut, but more of a liquidity negotiation, if you like, between everyone who gets in early.
Do you think that will become less necessary over time if, let's say, tokenization could demonstrate an influx of buyers and therefore liquidity prior to going public? Do you think we'll reach that point and then there won't even need to be, or there won't be a reason for going public? especially
I
considering the
think that's
costs of
yeah,
going public.
yeah. It's actually reverse in that, if anything, if tokenization becomes more and more in commonplace, and assuming the regulator now regulators are mostly technology neutral. Although I do think they need to um, change dynamically apply their regulation depending on what the technology can do, and therefore blockchain, the way they should apply to the blockchain should be very different, given the benefits it applies. But what they're focusing on, investor protection. If what you mentioned is going to happen, that effectively means they will be blurring or even the merge of a private market and a public market. In that case, the disclosure requirements and the information asymmetry that we talked about has to be beefed up, especially on the private market. So I do think that will then put on, if you like, heavier burden from that perspective on the companies. However, important thing is, again, going back to the technology itself, blockchain, if you think about why it is so hard to disclose and so on, the companies of any size do have audited financial statements. They do hold private investor calls. So they do that. They just don't have the ability to disseminate the same information to every single retail investor in an effective and compliant manner. Now, I do think blockchain, as I mentioned earlier, as a information dissemination mechanism, can be very effective in delivering that. So yes, the information disclosure requirements, as we see blurring of private market and public market, may get heavier on the companies, but that will be mitigated and improved by the introduction of new technology, i.e. tokenization and the blockchain. So that should offset each other, and that will also allow a regulator to focus on the investor protection. And that's also why I think the dynamic application of the way of the regulation, depending on the technology, is very, very important, because you don't want to end up taking only the downside, but you want to make sure you maximize the benefits the technology give you too.
Right. Agreed. Well, segueing a little bit. So right now, as of, June 2nd, June 3rd now, we've got a few companies that are going public and at massive valuations. So there's going to be this huge demand for capital. They're all competing for capital. How do you think that with all of that competition, it's going to affect pricing, investor appetite, and maybe even post IPO performance? We just said that most of the value creation is done. Like, what's going to happen next? Are these going to plummet and then retail is the exit liquidity?
That's a loaded question. The SpaceX just started roadshow today. And they also announced effectively the price at which they want to do IPO. Everything is getting clearer and clearer, and more information is available to everyone. And you can also see already the market perhaps is reacting to that. You can see the generally markets being soft, not because market is going to plummet from here, but because people need the additional capital to subscribe to that mega IPO, one gigantic one. Now, the capital isn't infinite, right? Even when we say they're abundant. So when you have such large raises, and we're not just talking about SpaceX, but we're talking about Anthropic, OpenAI, and collectively we're talking about people raising a trillion, no, maybe not trillion, but 100 billion and so on. They'll all compete for the same allocation, right? So the SpaceX scale raise can absorb demand that would otherwise spread across multiple IPO pipeline. So they could crowd out smaller listings, and also force softer pricing as well. So the sequencing really matters. The first major AI listing sets the tone. for everyone, and then that will be measured against. So the order of arrival can matter as much as the fundamentals. You don't want to be, if you like, the third name competing for the tired capital. Whoever leads into a fresh, uncrowded window tends to get better reception than those going into the tied capital. So I think the sequencing will matter even more, especially over the next few months.
You had mentioned that this could distract from smaller listings. Do you think it would also pull capital out of other asset classes? Is that something that tends to happen and could be happening right now? People are liquidating holdings in order to prepare for these massive IPOs?
I think so. I mean, that is a historical pattern that we see whenever we see a very sizable IPO. And if you, for example, if you look at it, the amount of turnover and trading that is done by the retail investors in the US is very, very significant. Yeah, so unlike the past, retail now is a very, very important and big part of public market trading. Now, SpaceX is going to allocate 30% of the 75 billion they're raising to the retail. Now, what I'm hearing is that is already very, very oversubscribed. Now, 30% of the 75 billion, you're talking about 25 billion and so on, right? So if you then think about that sort of money, and then that allocation, and let's say it's going to be 10 times oversubscribed, you're talking about 250 billion, and then so on. So the amount of money that will be locked up and then also need to be sold to make a room for it is very, very significant. So that's going to continue. I'm also seeing that the retail allocation and then a lot of anchor investors and the institutional, early investors will be subject to lockup between 3 to 6 months. Right, so they will not coming in anytime soon or liquidate anytime soon. The retail money that will be locked up and allocated, I'm hearing that it will be also subject to maybe 30-day lockup. So that will also lock up liquidity in the market. And then you have the Nasdaq rule change that will mean that the passive investors will start buying potentially SpaceX as early as 2 weeks into the IPO. The money has to come from somewhere. The money have to be coming from somewhere and liquidated in order to make room for the IPO. And the post IPO money have to come from somewhere. For the passive investors to be part of the track the index properly. So I mean, we've never seen something like this in any scale. And this you're talking about the biggest IPO in history. So I don't think anyone can tell you definitively what's going to happen, but we should expect lots of volatility around this.
Right, right. And I wasn't necessarily expecting you to have a crystal ball and to give out investment advice to folks, but it definitely is interesting. And I think that it's good for people to note that liquidation has to precede heavy investments. Now, do you think that any of that liquidity is being accessed through collateralization of existing holdings, or generally are investors averse to that because they don't know how the IPO is going to pan out?
I think some part of that, I'm sure, will be done through the collateral, but I don't know. I don't know how many of the brokers actually allow that. And if you think about so I think more retail investors probably will have to liquidate, or bigger percentage of that may come from either fresh capital or liquidation rather than through collateral.
Is there any correlation between what's happening in the market now and the crypto market, for example? I think that would be an easy perception of price drop. We saw that Bitcoin is down to like 63,000, 64,000, which is down a lot. It's been falling. Some of that is from the anxiety of the war in the Middle East, but Do you think any of that is related to these IPOs?
I think that could be. I mean, I follow Bitcoin fairly closely. When you actually look at this is sort of, we were digressing here a bit, but when I looked at the overall market order book of the Bitcoin, what we saw was actually there are a lot of sell orders around the 75,000, but from 70,000 below up down to 60, I think now it's about 63,000, something like that. There was a very little buy orders. In effect, it was almost like a vacuuming. So from that perspective, I don't think this drop was actually triggered by a lot of selling. It's just a buyer didn't exist. Lots of more buyers actually concentrating around the 60,000 and then so on and above. So from that perspective, many people have already withdrawn, if you like, potential liquidity, you can argue, relatively speaking, from the crypto, with Bitcoin as, if you like, a representative asset, to somewhere else, and in a part of which could be the new IPO allocation as well. So. I mean, of course, I mean, you cannot say, definitively again whether this is entirely driven by that. Difficult. I mean, some of it is relative macro sort of environment, like you mentioned as well. But I don't think you can deny that whatever happening in the equity capital market has nothing to do, with this.
Sure. And I know that was a tangent, but it is good to know. And that's interesting that you were looking at the order book, because it wasn't necessarily an increase in sell pressure at this price level. It's just the absence of buyers. And it's probably because people are not super confident. They don't know if it's going to break new lows and just keep on going down, or if this is a good price to get in at. Because if you got in around 60,000 and we finally break all-time highs of 120 plus, that is a 100% return. People are just gauging if that's worth the risk. Well, let's talk about Tessera. So what technology are you offering? What's your mission? Like, let's just do an overview of the platform.
At Tessera, we provide economic exposures to the pre-IPO companies. What, in effect, what we are trying to do is demystifying certain misconception people have, especially in TradFi. Now, a lot of people think when it comes to crypto, and tokenization, certain extent, they're confusing that they're treating the legal structure and the chain as the one decision. But we already touched on this several times, but important realization is the legal structure itself are sound, and they already exist in the TradFi to deliver what you need. All you need is a better rail to mitigate the settlement risk, better technology. So at Tessera, what you're doing is take the existing the legal structure that exists in the TradFi, and then map them onto the blockchain, and in that process, opening up and narrowing the access gap that exists to the retail investor. So concretely, the way it works is we use a combination of asset isolation using the Cayman SBC structure, as well as the loan syndication model, and to address the security characterization of the company, the exposures that you're holding. So you have issuer that it essentially issues loan products. So what the token holder receives is a loan participation rights to the product, up to the underlying companies. Yeah. And then that money then goes to the Cayman SPC, which then purchase the exposures to the underlying companies. And when the loan is repaid, then the exposures are liquidated, and the liquidation proceeds pass through the token holders. And that's how we transfer the economic exposures to the token holders, but not as an equity, and without the company ownership or being or subject to a dividend right. but only giving pure economic exposures, which is what almost all the retail investors are interested. And again, it's a technology that at investment banks use quite commonly, especially in order to, for example, access private market products or the emerging market products. So the legal structure exists. It's just that investment banking world didn't implement it. It has been behind the desk, if you like, because it wasn't implemented on a technology that allows a better settlement. And that's what at Tessera we are focusing on.
What does that look like from an investor user experience perspective? Is it complicated?
No, the result is that if you think about getting pre-IPO exposures today, you have to be an accredited investor. You have to pass the KYC. You also, in order to, so that's the first gate issue that you have. You have to qualify. You have to qualify first. And then in order to get the transaction done, you have to find the potential seller, for example. You have to negotiate prices, and you have to then do the due diligence on the chain of the ownership, what they call, so that there aren't any frauds. And then the settlement takes typically 2-3 weeks. And then after that, you may be locked up for 1 year, and you may not be able to buy the seller, so there will be no liquidity. So literally, that has zero liquidity value. So you just, that's what happens. Now, the result of what we have done is you have a liquid market for pre-IPO exposures that trades on blockchain 24/7 and that settles instantly, that you can access with your crypto wallet only, with no KYC and no accredited investor requirement that need to be met. And because there's a liquidity 24/7, you can buy, sell anytime you want. And we have also then integrated with a Chainlink proof of reserve. So that part of the chain of ownership due diligence has already been done, and you can verify that on chain again 24/7. So what I talked about earlier, what blockchain can provide, the settlement risk is mitigated by providing a DEX infrastructure that provides atomic transaction to settle instantly and trade 24/7. That creates the liquidity. And because of the atomic settlement, you do not need to have to meet those accredited investor. And that plus the way we structured, again, taking the technology from the TradFi, using as a loan participation right, our tokens that we issue are designated non-securities. And therefore, we do not need to have a KYC and the being an accredited investor status in order to trade. And when it comes to information disclosure and then in a verifying one chain of ownership, we have integrated with the Chainlink, which is the biggest oracle that we have in the crypto, to provide a proof of reserve, so that what you see in the TradFi is mapped onto the blockchain and provide the transparency 24/7 and anytime you want. So that way, the private equity exposures become a tradable asset, which was never the case in the past. And that you can see, so we launched SpaceX, for example, February this year. And over the last 3 months, they traded over 200 million. And that's the kind of demand that you can unlock.
That's impressive. Absolutely. Well, it sounds like you guys are doing very interesting work and, again, sharing the value creation that precedes an IPO, which is at this point the bulk of the value, with so many new investors who want that opportunity. So very exciting times that we get to tokenize private markets. And although we usually talk about real estate, which is generally a private market asset, there's all sorts of private market assets. You have real estate, infrastructure, private equity, private credit, venture capital, anything that is an investment opportunity that's not publicly listed. So it's good for people to become more familiar with all of this. Well, looking at 2026, are there any milestones that you're looking to accomplish? And then how would you like people to get involved?
We are continuing to list more assets. We are expecting, in fact, we are going to launch a new name in June, and that will be very interesting. 2026 is special because they are including SpaceX a number of mega IPOs. So it's actually great opportunity for people like us to really build infrastructure around it. And I think we're making good progress. If anyone wants to find more information, we are at www.tessera, tessera.pe, and you can find all the information. Yeah, you can take it from there.
Perfect. I will have links to your LinkedIn, your X, as well as Tessera's website in the show notes, so people will be able to scroll down and learn more about what it means to invest in a private company, what that opportunity is. And of course, there's risks associated with everything, so proper disclosure and certainly perform the diligence. And I know that your platform assists in parts of that and helping investors understand what's going on there. But nonetheless, it's an opportunistic time to be involved in either the investments or building the platforms that enable it. The fact that blockchain is once again that driving technology is fascinating. So many use cases and the new rails for the new industrial revolution, the digital one that we're going through. So any final comments before we say goodbye to the listeners?
No, I mean, I know you guys, you are focusing on tokenization and so on. When I started my career, we were at the bull market of the internet and so on. And then everyone said, oh, everything about the internet is so strange and is overvalued. Then, of course, we went through the boom and bust and so on. And then looking back 20 years now and think about how it transformed our life. And the AI wouldn't exist in absence of internet as well. So there are a lot of positive benefit. Now, blockchain is very interesting because I think blockchain can have the same kind of magnitude of impact to our daily life, even more so than the internet. And I think we are just starting to see, and we are still very early in terms of technology, precisely because blockchain deals with the money. And dealing with money is one of the most regulated and inefficient one that we have in human history. So I think that has a lot of potential, just as a technology, not necessarily crypto assets, but I think I recommend everyone to look at blockchain as an infrastructure rather than asset class and, take a long-term view because I do think it has a transformational power.
Great point and great place to wrap up. I agree. Well, Chan, thank you so much for coming on to Code and Concrete. Appreciate the conversation. Again, links to all of your stuff in the show notes, and I encourage all the listeners to check that out. And then, of course, leave a 5-star rating on the show. I'm wishing you all the luck, and hopefully if I make it out to Token 2049 in Singapore this year, we'll have an opportunity to meet up.
Definitely, that'll be very good. Thanks for inviting me again. Thank you.
Of course. All the best.